Pull up and grab your financial spyglass. We're about to dive into the turbulent seas of stock markets where crashes are more dramatic than a soap opera finale and corrections have more twists than a mystery novel. So join us on this thrilling escapade through time where we explore the most hair-raising moments in economic history and the daring adventures of modern investing. So today, let's talk about market mayhem and a whirlwind tour through time. Ahoy there, it's Phil and welcome to the Anti-Investor Stocks and Options Trading Podcast, where we talk about what really works and consistently wins at trading the financial markets. My goal is to give you the right tools, the correct rules, the software to assist you, a community to support you, and if you'll allow me, to be a mentor to show you the right way so that you get real results in the fastest and smartest possible way. Now then, let's get into today's topic and start recounting some of the historic market plunges. One of the big uns in recent times, and recent times could be anywhere in the last 150 years, but the big one is and has often been touted as the 1929 Great Depression. The stock market pretty much danced off a cliff and it sent the Dow Jones on a dizzying 25% fall in just 4 days, closely followed by the 1987 Black Monday crash, where the Dow Jones Industrial Average, which again, it played a huge game of hide and seek, and it quite literally magically disappeared 22.6% in a single day. So from a single day move, the 1987 crash was actually one of the bigger financial catastrophes, probably the only way of describing it. So by comparison, the 2008, one of the more recent ones in a lot of people's history, the 2008, the financial crisis that we saw then due to the subprime mortgage nonsense. They had an equally disastrous party, and it threw a third of its valuation quite literally out the door. So what we're kind of getting to grips with, if you think about some of the bigger market movements, what you'll start to notice is there's a lot of time between the huge market moving events, and obviously the 2020 crash in there that we all know about. That's obviously the most recent one that's on everyone's mind. I also want to briefly talk about corrections and basically the difference between a crash and a correction. A correction for me is anything more than 20% in a short span of time. Usually 10 to 15 days is my measure for that. And that obviously would lead to a crash, which is anything more than 20% in a short span of time. Again, usually 10 to 15 days. So 10 to 20 corrections, and 20 and beyond is going to be considered a crash. And again, both of those in a 10 to 15 day time period. So you've got lots of these little corrections that happen through the ages as well. Again, some of the bigger ones have been 2011. There was a huge plunge, if you like. It didn't quite meet that crash criteria, but it was close. It was a 19% drop, which was mainly due to the European debt woes. We also have 2018. Now, there was actually two corrective moves in 2018 for the eagle-eyed chart observer. You saw one at the beginning of the year and one at the end of the year, the February, March, and September, October time window. And what we start to build a knowledge bank of is when you start to look back through the charts. And again, I've just pretty much picked out the bigger of history's crashes and corrections. But what the cause of market chaos, these market downturns, they do spring from a variety of sources, from speculative bubbles popping to sudden economic downturns. Why, from my point of view, is not necessarily as important. And what I mean by that, in real time, these black swan events that by definition, black swan events. So trying to forecast them from what would cause it is a fool's errand. However, there will be writing on the wall as to what will be about to happen and what could happen sometime soon. And one of the things that I've always noticed is that there is a season for these shenanigans. They get jittery with seasonal changes, especially during the early part and the later part of the year. So what is the point of all this crash and correction talk? I'm glad you asked. The point is just very briefly to remind you, my loving and dear listener, that they don't happen that often. I've had quite a number of conversations about market crashes, market corrections. Many people are worried about them. Unjustifiably so, is what I would say. And I've done quite a lengthy study over multiple decades, and you can go back and look at the charts for yourself, and you can use a tool something along the lines of a zigzag indicator, which you can set as a percentage. It comes as standard on most platforms, and you can just say, hey, just show me all the swings up and down that are at least 10% or at least 20%, and you'll see that these big swings from certainly a downward movement, the crash and correction side of things, they don't happen with a great degree of frequency. So the why these things happen, it's up in the air. The why we'll find out afterwards with these things, but they do happen with a degree of, I wouldn't say predictability, but there's a reliable season for crashes and corrections. I've said this many times over the year, and I've had quite a few conversations, so it's just on my mind. So I just wanted to remind everyone that there's not a lot to worry about when it comes to these things. Certainly you need to be aware of them, and having a finger on the pulse of the markets when things don't look great. You should not panic in the face of every down day or red movement that we've seen, which is what we're looking at or what we've been looking at the last several weeks / months. We've only been seeing the markets go up for over 6, 7, 8 months, and now we're seeing a few little downward movements. Everyone seems to be panicking. So the reality is again, if you follow my exercise that I've just said, use a zigzag indicator as a percentage, you can visually see on the chart for yourself how big the moves are and with the frequency on the downside that they happen. And what you'll notice is what I noticed, and that a correction, which is a 10 to 20% move in a 10 to 15 day period, they happen on average about once a year. And there's a season for them, and this is the reliability or the predictability, if you like. If they're going to happen, they're most commonly seen February, March, or September, October. And those corrective moves, they happen to lead into a crash. Obviously, you can't have one. You can have a correction without a crash, but you can't have a crash without a correction. So the correction moves obviously lead into the crashes. And similarly, there's a season because of, one leads into the other. There's a season for crashes around February, March, and September, October. And you think about just the recent crashes, the bigger moves that we've seen that I've mentioned, they happened around this time, and there is a seasonality. I'm reluctant to say predictable because we've not seen that cycle unfold last year, and so far as I'm recording this year. Again, if you listen to this in the future, hello from the past. But it's at May 2024, we've not had a corrective move in 2023 at all, and so far this year we've not had a corrective move in 2024. So for me, all eyes are on the September-October window for a potential corrective movement. Now, with that said, just push that one side. A little bit of common sense. Again, as we're recording this, May 2024, if you look at the last part of last year, because the volatility, if you like, was so narrow by comparison to history, a 7% move was actually big for the last 15 or so months, 15, 18 months. So if you looked at the latter part of 2023, you'll see that there was multiple 5, 6, 7% moves in a short space of time. So with a little bit of common sense, we could say that, okay, well, 7% is a big move relative to the most recent price movements in the stock indexes. So February, March, if we look backwards, we've had almost a 7% move in that time window. Could that be considered the corrective move that I'm talking about? So maybe we've had it for this year, but again, I'll certainly be keeping an eye on things in September, October this year, just in case. But until then, there's nothing to worry about. Crashes happen with a regularity that you can set your watch by, but the good news is, while the movements do go hard and fast when they happen, again, the good news is that they don't happen that often. And if you've got a well-rounded, robust strategy that plays the bull swings and the bear swings in the markets, then it shouldn't really matter which way the market goes. You're not going to be caught on the wrong side of the markets, because you'll be profiting from the downward movements as well as the upward movements, which is how I like to develop my strategies. If you need a little help with that, shoot me a message, and if not, thank you very much for your time and attention and making me a part of your regular routine, and I will see you at the same time next time. Keep in mind that futures, options on futures, stocks and stock option trading involve a degree of risk that may not be suitable for all investors. There is a risk of loss in every investment that you make, and it's your responsibility to assess the risks of your decisions. Past performance is no guarantee of future performance, and Anti-Investor provides educational information and does not provide financial advice.